number of young people supporting a small number of old people. That leads to good economic growth, and the many countries in the world that have this pyramid now are all seeing economic growth rates of 5% a year or more. This is the population pyramid for the United States, and it doesn't look so hot. What this shows is you have a shrinking number of young people supporting an ever larger number of old people. And as an aging population and falling birth rate will bring you slower GDP growth, a growing demand for social services, rising budget deficits, and a weak currency, sort of like we're seeing in the United States right now. So this is the population of a country that has a mediocre growth outlook at best. Of course, it's a good thing we're not Japan. Japan currently has the world's worst population pyramid. Here are three pyramids for Japan: 1950, 2007, and 2050. You can see that 60 years ago, of course, they had a great pyramid. Large numbers of young people, almost no old people, because the lifespan then was only 55. Today, it's sort of bulging at the middle. Few young people, few old people, and a lot of people in the middle. That's not such a big problem. The real problem is the outlook, the projection for what their country will look like in 40 years. And there you see huge numbers of old people, a very small number of young workers to support them. And what this gets you is 2 workers for every retiree, bringing no GDP growth, huge demands for social services and medical care, enormous budget deficits, and collapsing currencies. What do you do in this situation? Well, you short their currency, the Japanese yen, and you also short their bond market, the Japanese government bond market, because it's just a matter of time before Japan has to start eating up its savings to support its old people. Now, the rise of the emerging market middle class is probably the single most important trend that's affecting markets right now. In 1980, the global middle class was 580 million people. Thanks mostly to the growth of China, it's now 900 million. But you add 2 billion people, you add rising middle classes in India, China, Latin America, and other emerging markets, and you get a total middle class of 2 billion people by 2050. So that means more than a doubling of the current class of consumers worldwide in 40 years. In 1980, the U.S. exported only 35% of its goods to emerging markets. Today that number is 54%, and it's rising very quickly. The purchasing power of the middle class in emerging markets has also been rising quite sharply. From 1975 to 2010, the per capita income in China rose from $100 per person to $3,000 a year per person today, and it's on its way to $6,000 per person. That compares to a U.S. standard of living, which has dropped from $50,000 a year to $46,000 now, just in the last few years. To show you how rapidly wages are growing in the emerging markets, in the last 30 years, South Korean wages rose from 5% to 65% of the U.S. level in 30 years. So the big picture view of what's happening here is that U.S. incomes are falling, incomes in emerging markets are rising, therefore you want to buy companies that are selling to emerging markets and less to the U.S. So we have 2 kinds of assets in the world today: paper assets or hard assets. Which should we do? What will it be? Well, paper assets are stocks, bonds, derivatives, loans, notes, promissory notes, and basically anything that can be made with a printing press. The potential supply is infinite. All you have to do is flick a switch and you can make some more. You have several countries around the world competing to print as much money as they can to solve their economic problems, effectively creating a race to the bottom. And to that I add the United States, Europe, Japan, even Brazil has started to print money. The problem is this creates huge inflationary risk down the road. We have to suffer the purgatory of deflation today to get to the hell of inflation a few years into the future. That is going to be a major factor dictating your investment decisions. Both political parties in the United States are in a race with each other to inflate as much as they can. This is how they get reelected. So regardless of who's in power in Washington, this is going to remain a big problem. And the net of all of this is that I think the 30-year bull market in paper assets is over. To make my case, take a look at this chart of the dollar, which goes back 220 years. People complain about the dollar being weak now, but it's always been weak. Sure, we've had good times and bad times, but the long-term trend has been down, and it accelerated the downtrend in the last century. First of all, when you created the Federal Reserve in 1913, then when we went off the gold standard in 1932, and then when our currencies were allowed to float against gold and other currencies in 1971. And since then, the downturn in the value of the dollar in terms of what it would purchase has been accelerating to the downside. So a weak dollar is not a bad thing. And this, by the way, is how the United States has always paid off its debts. It deflated the value of the dollar. Hard assets are in a completely different situation. It takes 5 years to bring a hard asset to market, to rip it out of a mine, to extract it from the earth, is a very capital-intensive, labor-intensive, long-term project. It requires enormous amounts of money now to open new mines, billions of dollars. There are shortages of the equipment that you need to develop these mines. Look at this truck at an iron ore mill in Australia, iron ore mine in Australia. There's a 3-year backlog to buy those tires, which cost over $100,000 each, and you can't mine the ore without them. Our education system has failed to generate sufficient numbers of engineers to develop new mines. The financial crisis froze all financing of new projects for 2 years, which is bringing forward peak demand in commodities all over the world. It created a bubble in the supply pipeline. We have environmental approvals, which are very difficult to get, especially in this country. That can drag out new projects for decades. Infrastructure requirements for these projects are huge. And I'm talking about roads, pipelines, water, electric power. All this stuff has to be put in ahead of time before you get your first ounce of ore out. The commodity industry generally suffered from 25 years of underinvestment from 1980 to 2005 because prices were low. It only took the price move that started in 2002 to get the ball rolling on new development. Bottom line, linear growth of commodities cannot meet the exponential demand that the emerging markets are creating. Now, there are many kinds of hard asset classes. The obvious ones are precious metals, gold, silver, platinum. You have commodity producing foreign currencies, the currencies of countries that are big resource exporters like Australia and Canada. Energy is a good hard asset. Peak oil is probably only 5 years away. You have natural gas, coal, and uranium. Remember, there's a renaissance of nuclear power that's about to begin. Other basic raw materials, copper, iron ore, rare earths, titanium, zinc, and nickel are in demand. Food is a hard asset, and that'll be great news for American farmers because we are huge exporters of the foods, and that's corn, wheat, soybeans, fertilizer, and seeds. Water is a hard asset. I'm predicting that someday fresh water will become more valuable than oil. So there will be demand for water rights, water purification infrastructure, and so on. Real estate is a hard asset, and I'll talk about that more later. Suffice to say, the only really interesting real estate plays right here are to buy agricultural land, especially in emerging markets, and emerging market commercial real estate. And of course, there are exchange-traded funds for many of these things, both the precious metals, basic raw materials, and the commodity-producing currencies and countries. Gold. Peak gold is upon us. It's rising to new highs almost every day. It's anticipating a return of high inflation that the relentless printing of money is bringing us. Production costs are rising. It's getting more expensive to produce gold. The number of mines are shrinking worldwide. Barrick Gold is not developing new mines at 15,000 feet in the Andes because it likes the fresh air. There's just nowhere else to go. The European central banks, after selling gold for 10 years, have stopped and have turned net buyers. Emerging